Introduction to Risk Management in Banking. Hi, my name is Christopher. Welcome to this journey through risk management in banking. In this chapter, we'll explore the types of risks banks face and the strategies used to manage them. Risk management is the systematic process of identifying, assessing, and prioritizing risks, then applying resources to minimize or control them. In banking, effective risk management is vital for maintaining financial stability, protecting depositors' funds, ensuring regulatory compliance, preserving shareholder value, and supporting economic growth. This module provides a comprehensive overview of major risk types and mitigation strategies. Types of risks in banking. Banks face several major categories of risk: credit risk, market risk, operational risk, liquidity risk, and regulatory risk. Credit risk arises from a borrower's failure to repay. Market risk is linked to fluctuations in market prices. Operational risk comes from inadequate processes or systems. Liquidity risk concerns the ability to meet obligations, while regulatory risk is about compliance failures. These risks are interconnected and must be managed holistically. Other important banking risks. Beyond the main categories, banks also face interest rate risk, foreign exchange risk, reputational risk, strategic risk, and systemic risk. Interest rate risk can affect profitability through changes in rates. Foreign exchange risk is tied to currency value fluctuations. Reputational risk can damage trust and impact business. Strategic risk comes from poor decisions, while systemic risk could trigger a collapse of the entire financial system. All these must be considered in a bank's risk framework. Risk interconnections. Risks often influence each other. For example, market disruptions can cause liquidity issues. Operational failures might harm a bank's reputation. Regulatory breaches can lead to financial penalties and increased credit risk. Because of these links, banks must develop integrated strategies. This interconnected nature makes risk management complex but essential. Credit risk. Credit risk is the potential loss if a borrower fails to meet agreed payment terms. It's the most significant risk for most banks and directly impacts profitability and capital. It influences loan pricing and provisioning and is a core focus of banking regulations. Key sources include default risk, concentration risk, collateral risk, and country risk. Managing credit risk is critical to a bank's stability. Credit risk management. Credit risk management begins with risk identification through credit scoring, financial analysis, and due diligence. Measurement involves calculating probability of default, PD, loss given default, LGD, and exposure at default, EAD. Mitigation strategies include collateral requirements, loan covenants, credit limits, and diversification. Ongoing monitoring uses portfolio reviews, early warning systems, and stress testing. For example, a bank might limit real estate lending to 20% of its portfolio to reduce concentration risk. Market risk. Market risk is the risk of losses from movements in market prices. It affects both trading and banking book positions and can change rapidly. This risk is particularly important in investment banking and requires advanced measurement tools. Types include interest rate risk, equity risk, foreign exchange risk, and commodity risk. Understanding these categories helps in designing mitigation strategies. Market risk management. Market risk measurement tools include value at risk, VAR, stress testing, sensitivity analysis, and duration analysis. Mitigation involves position limits, stop-loss limits, hedging with derivatives, and diversification. Monitoring uses daily mark-to-market, independent oversight, and regular reporting. VAR, for example, estimates potential loss over a set period at a certain confidence level. These methods ensure risks are kept within acceptable limits. Operational risk. Operational risk arises from failed processes, people, systems, or external events. It is present in all banking activities and can be hard to quantify. This risk can cause significant financial and reputational harm. Its importance has grown with increasing technological complexity. Common sources include human errors, system failures, fraud, and external disruptions. Operational risk management begins with identifying risks through self-assessments, process mapping, key risk indicators, and loss event databases. Assessment involves analyzing likelihood and impact, scenario analysis, and root cause identification. Control measures include internal controls, segregation of duties, authorization limits, and business continuity planning. Monitoring is done through incident reporting, control testing, audits, and management reports. This cycle ensures risks are addressed before they escalate. Liquidity risk. Liquidity risk is the danger of not meeting obligations when due without unacceptable losses. Funding liquidity risk is about cash flow shortfalls, while market liquidity risk is about difficulty selling assets quickly. The 2008 crisis showed how critical this is. Banks operate on fractional reserves and perform maturity transformation, making them vulnerable. Loss of confidence can trigger bank runs. Liquidity risk management measurement tools include the Liquidity Coverage Ratio, LCR, Net Stable Funding Ratio, NSFR, cash flow projections, and gap analysis. Stress testing helps simulate adverse scenarios. Mitigation strategies involve holding high-quality liquid assets, diversifying funding, extending liability maturities, and contingency planning. The Northern Rock case in 2007 shows how over-reliance on short-term funding can lead to collapse despite solvency. This underlines the importance of robust liquidity management. Regulatory risk. Regulatory risk is the threat of loss from failing to comply with laws, regulations, and standards. The regulatory environment is complex and constantly evolving. Noncompliance can result in heavy fines and reputational harm. Key areas include capital requirements, consumer protection, anti-money laundering, and data protection. Managing this risk is crucial for legal and operational stability. Regulatory risk management steps include monitoring regulatory changes, assessing impacts, implementing necessary policy updates, training staff, and conducting compliance reviews. Regular reporting to management and regulators is essential. Proactive management helps avoid penalties and operational disruptions. Compliance must be embedded in daily operations. This ensures banks meet both the letter and spirit of the law. Risk mitigation strategies. Strategies include risk avoidance, risk reduction, risk transfer, and risk acceptance. Risk avoidance means stopping activities that pose high risks. Reduction involves implementing controls to minimize risk impact. Transfer shifts risk to third parties through insurance or outsourcing. Acceptance means consciously taking risks within limits. Role of Basel norms. The Basel Accords are international banking regulations developed by the Basel Committee. Basel Y 1988 set capital standards. Basel II 2004 added supervisory review. Basel III 2010 strengthened rules after the financial crisis. Basel IV 2017 refined risk calculations. Basel III's main components are higher capital requirements, leverage ratios, and liquidity standards. The goal is a more resilient banking sector. Integrated Risk Management Framework. An integrated framework covers policies, limits, monitoring, governance, culture, infrastructure, and methods. It combines all risk types into one cohesive system. Risk governance ensures accountability. A strong risk culture promotes awareness and responsibility at all levels. This approach embeds risk management into the organization's DNA. Key takeaways: risk is inherent in banking and cannot be eliminated, only managed. Multiple risk types often interact, requiring a comprehensive approach. Effective management involves identification, measurement, mitigation, and monitoring. Basel norms provide a global framework for capital adequacy and discipline. A strong risk culture is as important as technical tools. Thank you. This concludes our session on risk management in banking. We have covered major risk types, their interconnections, management strategies, and the Basel regulatory framework. Remember, the aim is not to avoid risk entirely, but to manage it for optimal outcomes. Thank you for your attention. I am happy to take your questions.